IFRS 1 on first time adoption. IFRS 1 is simply for those that are adopting IFRS for the first time. That is, they are adopting it for just the first time in their financial statement. Now, the following are the things to be covered under the standard. We are going to look at the objective of IFRS 1, introduction to the standard itself, some of the key definitions, the issues with IFRS with the first time adoption, then factors to be considered in implementing IFRS in an organization, the benefit of harmonizations, the roadmap itself, and disclosure requirements. Now, this IFRS 1 is simply for those that are applying IFRS for the first time. That is, it is always adopted whenever a company is converting from local GAAP to IFRS for the first time. And this IFRS 1 sets out the procedure to be followed when converting from local GAAP to IFRS. It sets out the major procedures to be followed when a company is converting from local GAAP to IFRS. Now, what are the various procedures to be followed? Now, that is, IFRS 1 set out the procedure that anything must follow when it adopts IFRS for the first time as a basis for preparing its general purpose financial statement. That is, once IFRS has been adopted, it cannot be reversed again. The decision cannot be reversed again. That is, once it is adopted, the decision cannot be reversed again. Now, the following are the introductory part to this standard. Now, a first-time adopter is an entity that for the first time make an explicit and all-reserved statement that its annual report are being prepared with IFRS. That is, whenever a company prepares its account under first-time adoption, the companies must make a note and explicit statement that this account is prepared in line with international financial reporting standard. There must be a note that must state that particular item that the account is prepared in line with what IFRS. Now, an entity may be a first-time adopter if in the preceding year it prepared IFRS for internal management use, as long as those IFRS may not be made available. For example, now, if an entity prepared its previous year's account in line with IFRS, but that account was not published, then in the year the company intends to make the account to be known as published, then the company can be called a first-time adopter. That is, the IFRS is to be made public to the general public for the first time in the history of the company. Now, if IFRS for any reasons made available to owner or internal party in the preceding year, then the entity will already be considered to be an IFRS. That is, any entity that has previously prepared an account that is in line with IFRS in its previous years, then that entity is no more a first-time adopter. That is, once you have converted to IFRS 1 is no more applicable to you again. IFRS 1 is for those that are adopting IFRS for the first time. So once you have done your conversion, then you don't need IFRS 1 again. Now, but the following are still important again to be noted under the introductory part to IFRS 1. An entity can also be a first-time adopter if in the preceding year the financial statement has started complying with some but not full. What this is saying is that whenever you are preparing your account in line with IFRS, you must prepare a full IFRS account. There should not be a partial conversion. You must convert. Whenever you do a partial conversion, then your account is not in line with IFRS, because there must be a full conversion to IFRS. So that means that if you prepare a partial conversion, any year you are ready to prepare a full IFRS, then that year will be called your year of conversion. Now, the next thing that needs to be considered is included only a reconciliation of selected figure from previous GAAP. That is, what you show is just your reconciliation figure, but the basic thing that is required, other IFRS is not disclosed. So whenever you are ready to do such disclosure, then it is that time that you become a first-time adopter. Now, however, an entity is not a first-time adopter if in the preceding year in financial statement 1 comply with IFRS. If in the previous year all your accounts are prepared in line with IFRS, then you are no more a first-time adopter. Then if your financial statements comply with both your local GAAP and IFRS, but the key word is that it comply with IFRS, so in that case you are no more a first-time adopter once you have already prepared a previous account that is in line with IFRS. Now, the following are some of the definitions that needs to be noted. Number 1, what is date of transitions? There is a difference between conversion date and transition date. For example, now, if a company is to convert to IFRS in 2013, the transition date will be 2012. That is 1st of January 2012. That is the period before the conversion date. That is the comparative year before the year of conversion. That is the transition date. All this will be discussed when we get to the phases of conversion. Now, the next thing is deemed cost. Deemed cost is any amount that is substituted for cost or depreciation at a given date. Any amount that is replaced by IFRS as a substitute for cost or depreciated cost at a given date, that amount is referred to as deemed cost. What is fair value? Fair value is simply an amount in which a transaction on an item could be exchanged or a liability could be settled between knowledgeable willing parties in an arm's length transactions. Now, that is what fair value is all about. So IFRS itself is talking about fair value. Almost everything about IFRS is referring to fair value. All transactions must be disclosed at their fair value. Now, first IFRS financial statement. This is the first set of account that is prepared. That is, a company must make a statement when they are preparing their first IFRS statement, and that statement must be an explicit and unreserved statement of compliance with what? IFRS. Whenever a company is preparing IFRS for the first time, they must make a statement that this account is prepared in line with international financial reporting standard. Now, what is the opening statement of opening IFRS statement of financial position? An entity SOFP at the date of transition to IFRS. For example, now, if a company is converting in 2013, the opening IFRS account will be 2012, while the main conversion year is 2013. So transition date is the same as the opening IFRS financial position. What is the reporting date? Reporting date is usually 12-month period, which is covered by the financial statement. That is the reporting date, a 12-month period covered by the financial statement. Now, let's look at the problem company may face when they are converting to IFRS for the first time. Number one thing is that the date of transition. How will a company know its transitioning date? After that, which IFRS will be adopted? That's another problem a company may face. And even when you are doing conversion from Nigerian GAAP to IFRS, there will definitely be some differences. Now, how will those differences be accounted for? That is either gain or losses. How should they be accounted for? These are some of the problems. Then, explanation and disclosure to be made in the year of transition. Number one thing about IFRS is that IFRS is preaching full disclosure. That is, there must be a full disclosure. Nothing should be hidden under IFRS. There must be a full disclosure. That is what IFRS is preaching. There must be full disclosure. And the final thing is that what exemptions are available to companies. So all these questions will be answered in subsequent lectures. First of all, let's start with the date of transition. The date of transition is the beginning of the earliest period for which an entity prepares full comparative statement under IFRS. If a company conversion date is 2013, date of transition is the opening of 2012, which is the previous year. That is 1st of January is the date of transition. Now, IFRS should be applied from the first day of the set of financial statement published in compliance with IFRS. This is called the opening financial statement. In this case now, that 2013 is the conversion period, the opening financial statement is 2012. Because IFRS requires comparative statement to be published, the opening financial statement for entity should be prepared in line with what? IFRS. That is, both the opening and closing, which is like comparative should be prepared in line with IFRS. But the opening statement itself needs not to be published, but it will be shown as part of the comparative figure to the one that will be published, which is the closing statement. Now, the next question that needs to be answered is which IFRS should be adopted. That is, which IFRS itself should be adopted. Now, whenever a company is converting to IFRS, they should be able to answer the following question. There are 4 questions that need to be answered. That is, number 1, recognize all assets and liability required by IFRS. When you are converting to IFRS for the first time, there are some assets and liability that needs to be recognized by IFRS. For example, now, under the intangible asset development cost that we used to expense under our local GAAP, but under IFRS, developmental cost should be recognized if it meets the recognition criteria. So in such case, if developmental costs are being expensed under IFRS, it must be recognized. That is the new rules for developmental cost. This will be explained further under the intangible asset. Another keyword that worth noting is the recognized asset and liability not permitted by asset. Any item that does not allow for recognition under IFRS should be what? Recognized. For example, now, there are some conditions for provisions. That is, for us to make any provisions, 3 things must occur. Number 1, there must be an obligation which results from past events. Another thing is that the amount must be reasonably known. Another thing is that it must result in future cash flow. So if a previous recognized provision does not meet any of these criteria, it should be what? Recognized from the books. That is, the recognized asset and liability not permitted by IFRS. The third thing is that reclassify all asset and liability and equity component of the statement. That is, some items may be reclassified as explained under IFRS 1, that redeemable preference shares will be reclassified from equity to non-current liability. So these are the reclassification that needs to be done under IFRS 1. Then the final thing is that measure all assets and liabilities in accordance with what? IFRS. For example, now measurement needs to be done. Some assets need to be measured at their fair value. Then the major thing is that deferred taxes balance may have been discounted to present value, but IAS 12 does not permit discounting. Therefore, the amounts will need to be remeasured on an undiscounted value. That is, you need to do some measurement of some assets to be aligned with IFRS. Majorly, all PPE may likely be revalued, at fair value, so that they can be remeasured for us to know the actual sense of the value of the company's asset under IFRS. So those are the 4 questions that need to be answered. Number 1, recognize all asset and liability required by IFRS. Number 2 is the recognized asset and liability not permitted by IFRS. Number 3, reclassify all asset and liability and equity components in accordance with IFRS reclassification. Then measure all asset and liability in accordance with IFRS. Now, the next point is this: how do we recognize gain or loss on conversion? One thing about IFRS is that when you are converting, any gain or losses that you arrive at from conversion should be transferred directly to retained earnings. It is retained earnings that will suffer everything. If it is gain on conversion or loss on conversion, all should be adjusted for in the retained earnings. That is, all the transitioning resulting figure adjustments, balancing figure should be transferred to retained earnings. Now, the next thing is this: explanations and disclosure. What IFRS expression is that there must be a full disclosure. That is, there must be a detailed disclosure of transactions. Now, let's look at some of the things that is required under the disclosure. The first thing is this. Now, 2 main disclosure is required. That is, the entities equity as reported under previous GAAP must be reconciled to the equity reported under IFRS. This can be done through the statement of changes in equity. You must reconcile your Nigeria GAAP equity to that of IFRS, doing adjustment required. Now, before you can do any conversion, you need the following. Number 1, you need 3 statements of financial position. That is the audited account. All conversion will be done based on audited account only. Do not use management account to do conversion. You will make use of only the audited account. You need to know the following when you are converting: date of transaction and the delayed statement of financial position under GAAP. These are the things that will assist you when you are converting. Now, after knowing that you need 3 statements of financial position, the next thing that is required is the last annual profit or loss reported under previous GAAP must be reconciled to the same year's total comprehensive income prepared under IFRS. There must also be reconciliation of the old profit and loss account with that of the IFRS. Why any material differences between GAAP and IFRS must be explained. There must be a detailed reconciliation statement for all those material differences. Now, items which do not qualify for recognition as an asset or liability under IFRS must be what? Excluded. That is, all items that do not qualify under asset or liability should be what? They recognize instantly. That is the new rules. For example, now under the IAS 38 on intangible asset, items such like trading costs, all these items should be recognized from asset and they should be expensed. That is the new rule. Now, all these things, for example, now the last thing is that your goodwill, they should be tested for impairment. All goodwill should be tested for impairment annually. Before, we used to amortize goodwill, but in line with IFRS 3, all goodwill should be tested for impairment only. Now, the final thing that needs to be discussed here is the share-based payment transaction. What is share-based? Share-based is when a payment is made with what? With shares. Instead of the actual payment itself, shares are being issued. It could either be for expenses or assets. For example, now, most companies can promise their staff that if they perform in a particular period, probably in the next 5 years, they will issue out shares for them. In that case, at the time where the promise was made or where the agreement was signed, that is referred to as the granting date. That is the date where the agreement was made or the contract was signed. At the granting date, all those promises made by the company should be what? recognized in the books. For example, if companies promise to pay its staff 1 million shares if there is a performance in year 5, in 5 years' time, that means that the granting date we must recognize that 1 million naira by debiting the employee's benefit account and credit shares to be issued account.